Listen audiobook.
Welcome to the Listen audiobook channel, where timeless wisdom meets practical thinking and powerful life lessons. Today, we explore one of the most respected and influential books ever written on investing, The Intelligent Investor by Benjamin Graham. This is not a book about getting rich quickly, predicting the market, or chasing trends. It is a book about discipline, patience, emotional control, and long-term success. It teaches you how to think clearly when others panic, how to act rationally when others become greedy, and how to protect your money while allowing it to grow steadily over time. Benjamin Graham, widely known as the father of value investing, was not interested in excitement or speculation. He was interested in logic, safety, and consistency. One of his most famous students, Warren Buffett, has repeatedly said that this book shaped his entire investing philosophy. Even though the book was written many decades ago, its lessons are more relevant today than ever, because while markets change, human behavior never does. Fear, greed, impatience, and overconfidence still drive most financial mistakes. The Intelligent Investor exists to help you avoid those mistakes by changing the way you think about money and investing. At its core, the philosophy of this book is simple yet powerful. Investing success does not depend on how smart you are. It depends on how disciplined you are. It is not about predicting the future, but about preparing for uncertainty. It is not about beating the market, but about avoiding foolish decisions. Graham believed that the biggest danger to investors is not the economy, the market, or bad news. The biggest danger is the investor's own emotions. That is why this book focuses more on behavior and mindset than on numbers or formulas. Graham makes a clear distinction between investing and speculation. Investing is based on analysis, safety, and reasonable returns. Speculation is based on excitement, hope, and guesswork. The intelligent investor always chooses logic over emotion and patience over impulse. The first powerful lesson of the intelligent investor is that you are not competing with the market, you are competing with yourself. Most people believe that investing is about outsmarting others, but Graham explains that the real challenge is controlling your own behavior. When prices rise, people become confident and greedy. When prices fall, people become fearful and desperate. These emotional reactions cause investors to buy at high prices and sell at low prices, which is the exact opposite of intelligent behavior. Graham introduced the idea of Mr. Market to explain this concept. Imagine the market as a business partner who comes to you every day and offers to buy or sell your investments at different prices. Some days, Mr. Market is optimistic and excited, offering very high prices. Other days, he is depressed and fearful, offering very low prices. The intelligent investor does not follow Mr. Market's mood. He does not argue with him or try to predict his behavior. Instead, he uses Mr. Market's emotions to his advantage. When prices are unreasonably high, the intelligent investor waits or sells. When prices are unreasonably low, the intelligent investor buys. The key lesson here is emotional control. In real life, this means ignoring panic during market crashes, avoiding hype during market booms, and sticking to a long-term plan. Successful investing is calm and boring. Emotional investing is stressful and costly. The second powerful lesson is the concept of the margin of safety, which is the most important rule in investing, according to Benjamin Graham. The margin of safety means buying investments at prices significantly below their true value. This creates a buffer that protects you from errors, bad luck, and unexpected events. Graham understood that no analysis is perfect and no future is certain. Instead of trying to be exactly right, he focused on reducing the risk of being seriously wrong. By buying with a margin of safety, even if your assumptions are not completely accurate, you still reduce the chance of permanent loss. Think of the margin of safety like a safety net. You hope you never need it, but it protects you if something goes wrong. In practical terms, this means avoiding overpriced and popular stocks, being patient when prices are too high, and waiting for opportunities where value is clearly greater than price. The intelligent investor would rather miss an opportunity than take unnecessary risks. Patience is not weakness. Patience is protection. The third lesson is that investing should be treated as a business, not a game or a form of entertainment. Many people approach investing the same way they approach gambling or sports betting. They follow daily news, react to headlines, and make decisions based on short-term price movement. Graham strongly warned against this behavior. When you buy a stock, you are buying ownership in a real business, not just a piece of paper that moves up and down. That business has products, customers, earnings, and long-term goals. The stock price may change every day, but the real value of the business changes much more slowly. The intelligent investor focuses on the strength and stability of the business, not on daily market noise. Graham also explained that frequent trading often leads to higher costs, more taxes, and worse results. In real life, this lesson means thinking like an owner, not a trader. It means asking whether you would be comfortable owning the business for many years, even if the stock market temporarily closed. If you would not feel comfortable owning it long-term, it is probably not an intelligent investment. The fourth lesson is understanding the difference between defensive investing and enterprising investing. Graham recognized that not all investors have the same goals, skills, or amount of time. A defensive investor seeks safety, simplicity, and steady growth. This type of investor prefers diversification, low effort, and minimal risk. An enterprising investor is willing to spend more time researching, analyzing, and actively searching for undervalued opportunities. Both approaches can be successful, but only if chosen honestly. Graham warned that many people believe they are enterprising investors, but do not have the discipline, knowledge, or emotional strength required. Pretending to be active without the proper skills often leads to losses. The intelligent investor chooses a strategy that matches their personality, lifestyle, and ability to stay disciplined. There is no shame in being defensive. In fact, for most people, defensive investing leads to better results over time. The fifth and final lesson is that long-term discipline always beats short-term predictions. Benjamin Graham did not believe in market forecasting. He believed that predicting interest rates, economic cycles, or market movements is unreliable and unnecessary. Most predictions are wrong, and even correct predictions often lead to poor decisions due to timing errors. Instead of trying to predict the future, Graham focused on preparation and consistency. The intelligent investor invests regularly, remains patient, and stays disciplined through both good times and bad. Time is the greatest advantage an investor can have. Compounding works best when you remain invested and avoid emotional decisions. In practical terms, this means stopping the attempt to time the market, avoiding constant buying and selling, and trusting a well-thought-out strategy over decades. Wealth is built slowly, quietly, and consistently. When all these lessons come together, the intelligent investor mindset becomes clear. Control your emotions. Demand a margin of safety. Think like a business owner. Choose a strategy that fits you. Stay disciplined for the long term. This book does not promise excitement or instant success. It promises stability, clarity, and resilience. It teaches you how to survive market crashes, avoid costly mistakes, and build wealth with confidence and patience. The true value of the intelligent investor is not in specific techniques, but in how it reshapes the way you think about money. If you can remain calm when others panic, rational when others become greedy, and patient when others rush, you gain an advantage that most investors never develop. This is the timeless wisdom Benjamin Graham gave to the world, and this is why The Intelligent Investor remains one of the most important financial books ever written. Thanks for listening. See you in the next video.